everyone, welcome to The Explainer. Today, we're popping the hood on one of the most widely used technical indicators in the financial markets, the MACD. If you've ever stared at a messy chart and thought, how on earth do traders actually make sense of this chaos? Well, you're in the right place. We are going to completely deconstruct this tool and see exactly how its internal gears turn.
But before we get into the fun stuff, we gotta set the stage with a pretty sobering reality check directly from our source material. 71%. That is the percentage of retail clients who literally lose money trading CFDs with this specific provider. 71%. The stakes here are incredibly high. With leverage, you can lose your capital in a blink, and these are highly complex instruments. So really understanding these tools isn't just some academic exercise, it's absolutely critical if you're even thinking about getting into these markets.
To avoid cognitive overload, here's our roadmap. We'll define the MACD, pull apart its anatomy, and then explore 3 distinct trading strategies: line crossovers, histogram reversals, and zero crosses. Finally, we'll wrap up with the timing of your strategy.
All right, Section 1. What is the MACD? Demystifying the acronym.
Okay, so MACD. It stands for Moving Average Convergence Divergence. I know, it's a total mouthful of financial jargon, but at its core, it's just a trend-following momentum indicator. Basically, its main job is to measure the momentum of an asset to figure out if the overall trend is heading up or down. That's it. It helps traders spot potential opportunities in all the market noise.
To really get what this acronym means, you kind of have to visualize the mechanics happening on the chart. It's all about the relationship dynamics between moving averages. When the lines are coming together, they're converging. When they're pulling apart, they're diverging. That push and pull, that coming together and splitting apart, is literally the engine that drives all the data this indicator spits out.
Moving right along, Section 2. Anatomy of the indicator. Deconstructing the tool.
So what are we actually looking at here? The MACD has 3 main visual components. First up, the MACD line. Now on a chart, this might look like your standard simple moving average, but it's actually a layered exponential moving average, or EMA. Then we have the signal line, which is just a faster layered EMA. And finally, the histogram. This is those little bars you see, and it visually represents the literal difference between those first 2 lines.
Section 3. Strategy 1. Line crossovers. The lagging indicator approach.
Let's dive into our first battle plan. This strategy uses the MACD line and the signal line sort of like a stochastic oscillator. And honestly, the mechanics are wonderfully straightforward. Step 1. A buy signal triggers when the faster, more reactive MACD line crosses above the slower signal line. Step 2. A sell signal happens when the MACD line drops below the signal line. You're basically just hawking those intersection points. But here is the catch, and it's a big one. This strategy comes with a built-in flaw, because crossovers are lagging by nature. You're waiting for a move to actually happen before you open a position. The danger is that in a weak trend, by the time those lines cross and give you a signal, the price might already be reversing. Traders call this a false signal, and it's a huge reason why relying on price action for confirmation is usually a really smart move. And, this perfectly illustrates a massive dividing line in technical analysis: lagging versus leading strategies. The crossover strategy we just looked at, it lags, it waits. But what if you don't want to wait around? What if you want to use known trends to execute a trade before the big move actually fully materializes? Well, for that, you need a leading strategy.
Which brings us to Section 4. Strategy 2. Histogram reversals. Reading the bars.
The really elegant thing about this approach is that it focuses on the histogram, which honestly might be the most useful part of the whole MACD. Remember, the height of those bars literally shows the exact distance between your MACD and signal lines. So, when the market price surges, the lines pull apart and those bars shoot up. When momentum dies down, the lines get closer and the bars shrink. It's like a visual heartbeat of market momentum.
Because the histogram actually shows us the lines tightening before they cross, we can use it to spot reversals super early. After a big expansion phase, you'll start to see this distinctive hump shape form in the bars. When you see that hump, it's your early warning sign that a crossover is impending. Now, to avoid getting faked out by a random one-off blip, smart traders usually wait for 2 distinct counter-trend moves in the histogram before jumping in. And your exit? You simply bail once the MACD starts to reverse back in the opposite direction.
Section 5. Strategy 3. Zero crosses. The slow and steady signal.
All right, so instead of watching for the 2 lines to cross each other, this strategy is all about watching either of the EMAs cross that baseline 0 mark. Step 1, if the MACD crosses the 0 line from below, it signals a new uptrend, time to buy. Step 2, if it crosses from above, a new downtrend is starting, meaning it's time to sell or close out a long position. Simple as that.
Now, a quick heads up, this is definitely the slow poke of the three methods. Because it takes so much longer for the averages to reach the zero line, you're going to get way fewer signals. But the massive upside, you also get way fewer false reversals. In a fast, choppy market, this delay means your signals might arrive way too late. But if you're trying to ride long, sweeping market moves, the zero cross is an absolute powerhouse.
Section 6. Timing your MACD strategy. When should you actually use it?
Let's wrap our heads around all this with a quick summary matrix to weigh our options. First, crossovers. It's a lagging signal, meaning it waits for movement. The catch? You're going to have to be glued to your charts, monitoring things to catch those signals in time. Next, histogram reversals. This one is leading. It executes before the move, so theoretically it requires a little less constant babysitting. And finally, zero crosses. The slowest signal type. It requires serious patience and is heavily characterized as being best for sweeping moves with fewer false signals.
Ultimately, as our source material makes very clear, there's literally no universally best time to use the MACD. It's not a crystal ball. Some traders never use it at all because they don't like technical analysis, or they just prefer other indicators. If you do use it, the timing is 100% dependent on your personal preferences, your risk tolerance, and which of these three strategies actually fits your style.
Which leaves us with the ultimate question. The MACD is this incredibly powerful, flexible tool that can track momentum and give you critical market insights, but only if you actually know how to wield it. We've taken the tool completely apart, but a tool is useless without a plan. So looking at everything we just covered today, from lagging crossovers to those early warning histogram reversals, what is your personal trading plan? Think on that. Thanks so much for joining me for this explainer. Keep studying those charts, and I'll see you next time.